corporate finance, advanced topics, often classified as such, what we're going to be doing. And I want us to also look at some stock data, just putting some things properly. Let me see this. So there are a number of stuff we're going to be looking at today, right? Let me just, I don't know why my app opening this document, it's still freezing. Okay, I think I have my stock data here. Good. Great. A lot of work. Guys, just a second, and then I'll share my screen. Just a second, then I'll share my screen. All right, great. Let me have my screen shared. And please alert me once you can see my screen with a thumbs up. Thumbs up, please. Can you all see my screen? I can see the charts. Okay, good. Can't wait. I think for more. Okay, good. I see all that. All right, great. So what we're going to do today is going to be exciting. I started the discount rate discussion, and what we did, we looked at the risk-free rate, and I said that if we want to put a price on risk, we should first start by putting a price on maybe something that has no risk. If there's no risk at all, what price can we put on that? And then when we have risk, how do we incorporate risk into, and maybe how do we put a price on the risks you are bearing? So we start with a risk-free instrument, and we looked at how to determine the yield on the risk-free instrument. That's what we did. All right. What we're going to do today, we're going to take the discussion to another level, and we will start talking about the capitals. The weighted average cost of capital. That's what we're going to do today. Okay, so let me just get into my lectures. Still on module 2. And so the lesson is equity risk premium and beta statistic. So I hope to complete this today. The interesting thing here is that we have just 2.5 hours, so to say, and today I'm going to use it fully, just as I've been doing. But this class is going to be a bit difficult for maybe some people. Some people may not consider it difficult or may not see it difficult because perhaps we've already had some idea about what I'm coming to say. I will be talking about a lot of things that are coming from different topics, including statistics and regression analysis. I'll be doing all that today. Let's get into this and see, and even portfolio theory all coming in here. That's why the discount rates are among the top or the difficult topics in corporate finance and often considered advanced topics. I and again want to say that how we estimate discount rates differs, or it differs depending on the project we're looking at or how we're trying to estimate the item whose value we are trying to estimate. If it is a fixed income instrument, how discount rate will be estimated will be a bit different from what we're doing here. So I explained the basis of that yesterday. I think that was Friday, and I told you that the risk inherent in the instrument is what guides the estimation of the discount rate. Now, so the first question we want to address today: why the weighted average cost of capital is irrelevant for banks. And you may be wondering why this topic coming. Because weighted average cost of capital, you've been studying this in the university and had always been relevant. So why is it relevant for the banks? Maybe there's a reason, and we want to explore that today. Why is it irrelevant for banks? How I'm going to approach this is this. I'm going to start by first talking about how the weighted average cost of capital is, how it's estimated, and then I'll tell you why it's irrelevant. What it is and how it's estimated, ladies and gentlemen, I may not do the things the way you studied it in maybe your MBA programs. What I'm coming to do is what is done in practice and theoretically correct, and that is what is done. I have no idea about what you studied in school, and so it's likely to conflict your previous knowledge on the topic. It may conflict it. So you just have to bear in mind that. All right. So I've been doing this for quite some time now. In practice, I've done this a lot of times. And I have enough experience to make some comments, or to pass some comment. Now let's talk about the weighted average cost of capital. So what you studied in school, you can see it here on the screen. That is not wrong to say. The kind of questions you face when you're doing your, maybe some accounting professional exams and all that, most of those questions are theoretical. They don't reflect what is done in practice. In most cases, even to your MBA program, most of the MBA programs, the finance topics, or maybe the questions or the topics that have to do with the weighted average cost of capital and all the discount rate estimation, most of them are like theoretical. Not just that they're theoretical, but also they're quite juvenile. They are like an introduction to the concept, okay? And they are vague. They are not applicable, okay, to real life. And another thing is that they tend to give you the variables, or maybe the various estimates, okay, or statistics. They tend to give them to you on your exams or in the textbooks. But in practice, you got to estimate them. And estimating them is hard. It's not easy at all. It's hard. And that's the reason why you need to take this class seriously than even what we did on Friday on Risk Spirit. And I'm hoping to complete it. But I'm not in a hurry as well, because this is just taking 2.5 hours of our time after work. If I'm not able to complete all this within the time designated, we can negotiate a day or two again to extend our lectures. As per my plan, I'm supposed to complete the discount rate today. But in case I'm not able to complete, which is more likely than not, I may continue tomorrow. The reason why I may not want to pack everything into today is because it's actually a very vast topic. That's one. Number two, there will be a lot of new concepts and a number of people will be learning for the first time. So you may get missing along the way. But a good thing too is that these sessions are being recorded, so you can always go back to listen. Now let's talk about weighted average cost of capital. So the WACC we know is the average cost of debt and equity capital used by company to finance its assets. When we start valuation, I'll show you what we call the finance balance sheet. And I'll compare the finance balance sheet to the accounting balance sheet. And I'll show you how we price things on the finance balance sheet based on market value and how things are valued on the accounting balance sheet based on book value. So if you compare the accounting balance sheet to the finance balance sheet, you can then see from the perspective of finance how the value of a company is determined, or why the value of a company or the market value of a company will differ from the book value of the company on the balance sheet. In other words, why the market value of equity may differ from the book value of equity. You will tend to see that. And I intend to make plain everything. I want to clear every possible doubt so you understand everything really well. I'm coming from both academia and practice. So I think I can answer your questions really well from both the practice perspective and also from the academic perspective. So when we're determining averages, there are multiple ways of determining averages. One is to do a simple arithmetic average. We also have, which we call arithmetic mean. In the arithmetic mean, and those are basic things I don't want to really get into the detail. In arithmetic mean, what we essentially do, or where we actually sum up the items or sum up the number of data points and dividing them by the number of occurrence, right? In that arithmetic mean calculation or averaging, we assume that each data point has equal importance. In other words, if we have two numbers, 5 and 3, and we want to determine the average of 5 and 3, what do? We add 5 to 3, and that gives us 8. And how many items are we summing up here? Two items. So we do 5 plus 3, 8, and then we divide by 2, and that gives us 4. What we are essentially doing is that we are assuming that both 5 and 3 have equal weight or equal importance. So that approach, or what I've just done, can actually be decomposed into one half of 5 and 1/2 of 3. Right? It means 50% times 5, 50% times 3. That gives us that 4. Now, that doesn't work quite well. When we take how companies raise money broadly from debt sources, source and equity sources. So we need to know, or the amounts raised from equity may be different from the amounts raised from debt. So they may not be of equal amount. Because they are not of equal amount, or they may not be of equal amount, the use of arithmetic mean will actually render your calculation not useful, right? Not useless, but not useful. Because suppose we have a company that has 60% equity, 40% debt. That company, when you're calculating the average cost of funding, you are not going to do, let's say the cost of funding equity is 12%, the cost of funding debt is 10%. You can't just say 12% plus 10% divided by 2, which will give you 11%. No, because the capital raised in debt and equity are not of equal proportion. So the use of arithmetic mean here will not work well. So we need to move to something we call a weighted mean. The weighted mean takes into consideration the weight of the various capitals. So equity is 60%, debt is 40%. So we are considering the weight. In this case, it could be that equity raised was 600 million and debt capital was 400 million. So the total capital is 1 billion. So when you take 600 million divided by 1 billion, it gives you the 60% I was alluding to earlier. And when you take also the 400 million divided by 1 billion, it gives you the 40% that I alluded to. Now, so that's what we do in weighted mean computation. We consider the weight of the constituent of the asset in the determination of the average cost of raising finance. Hence the term weighted average cost of capital. Now, capital must be equal to assets in accounting sense. In other words, the value of assets any company has must be equal to the value of the capital used, or must be equal to the total capital used to finance the asset. Capital is needed to finance assets. That's why I said that the WACC is the average cost of debt and equity capital used by a company to finance its assets. So when you look at on the formula here, you have the weight, the W means weight. Okay, I've defined them here. W means weight, RE means return on equity or cost of equity. We're going to get into the details of each of these things. WP means weight of preference shares. Then here is the cost of preference share, which is the RP. I can either say return on preference share or I can say cost of preference shares. I'll get into the details of that. Now, WD is the weight of debt, and RD is the cost of debt or the return on debt. Now, the 1 minus T is arising as a result of the fact that in the computation of corporate tax on the P&L, the regulators, the tax bodies, the tax authorities, I say regulators, the tax authorities allow for interest on debt. So if you have debt on your balance sheet, the tax authorities will say, well, before we calculate tax on your profit, we allow you to deduct interest expense from your operating profit before you calculate the tax on the profit. So when that is done, the tax you'll be paying will be lower. The tax is lower because you are deducting your interest expense from operating profit before tax is calculated. So the tax is calculated on a lower amount. Oh. Now, so that lower amount is what we call the profit before taxation. Now, no, so if you have a company, another company, that doesn't have debt, meaning it doesn't have any interest expense, that company will not enjoy that benefit of a lower tax. So if you take a company and you are looking at two scenarios, scenario one is that the company has debt, and scenario two is that the company doesn't have debt. So it's all equity finance. It has no debt. But scenario one, the company has both debt and equity, or in other words, it has debt. If they all have the same results, they have the same revenue amount, they have the same expenses, the same costs. In other words, they have the same operating profit, 1 million, 1 million. We want to see which one will pay a lesser tax. The one that will pay lesser tax is the one that has debt, because it's the one that will have to subtract interest on his debt. Now, so that makes the use of debt beneficial. In other words, there's a technical language we say the debt is tax deductible. Not that the debt is tax deductible, let me correct it. The interest on debt is tax deductible. Economically, when you borrow from a bank and the bank is quoting 15% interest on the debt, you have to pay the 15% to the bank. However, in economic terms, because you are enjoying some return or some benefit because you have debt, when you are looking at the net cost of the debt to you, you don't just look at the 15%. No, you are paying 15% to the bank, but you are getting some form of a refund from DRA or from the tax authority, Ghana Revenue Authority, or which other country, the tax authorities in your country. You're getting some form of a refund in the form of a lower tax you are paying to them because you have debt. So when you take the 15% you're paying minus that benefit you are taking, you are getting back from DRA or the savings you are making, when you do that, then the net is the actual cost of debt to you, or the cost, the net interest cost to you. We call that a post-tax cost of debt. That's the reason why when you have the cost of debt here, we do 1 minus T. 1 minus T will give us the post-tax. So here we are taking out of the cost of debt, out of that 15% example I gave you, we are taking out of it the tax benefit. Now, I put this thing here. It looks mathematical, but that's quite easy. Sometimes we use mathematics to write sentences that we don't want to take so much time to write, right, in words. What I'm saying here is that each of the weights here, the weight of equity, weight of preference share, weight of debt, they are all non-negative. None of them is negative. They're all positive values. That's what you have here by all of them being greater or equal to zero. Either zero or they are non-negative. Non-negative is key assumption. The second one I've done here is that all the weights sum up to 100%. They sum up to unity. So the sum of all the weights is to, if when you sum them all up, they are all countable items. When you sum them up, it gives you unity or one. Now, so I just talked about cost of debt. Now, so the cost of debt here is a cost to the issuer of debt. So an issuer of debt, sometimes some of this is confusing to people. When we say issuer of a debt, oftentimes this language is used in the context of bond. Company have bond. The issue is a bond issuer. So we call it the issuer of a debt instrument. That issue of a debt instrument must pay some interest to the investors. That's one. Another way to issue a debt instrument is to go for a bank loan. When you go for a bank loan, it's in the form of you rather issuing it and the bank agreeing to buy that instrument from you by giving you the loan. Okay, so that's a cost to you. When you take a loan, it becomes a cost to the company, but it's a return to the bank. So you can see that we can have a return on debt and we can also have a cost of debt. Depending on who you're talking to. The same thing applies to cost of equity. To the company, it's a cost, but to the investors that bought the equity security is a return to them. So they will call it investor required rate of return, and the company will call it cost of return or cost of equity. It's a cost to the company. So the company wants to know what investors consider as a return. Okay, the company is interested in what investors consider as return. Look, it doesn't matter about what the company itself thinks the return should be. It's about what investors are considering as return, because the company has no control over how investors view them. Right? Good. So investor is king here. Let me check if there's any question. Then I'll move to the second slide. Fantastic suggestion, Julius. Yeah, great. No video today. Yes, no video today. No video today, but there'll be video tomorrow. All right, let's go. Now let's take a look at the WACC further. And we talk about debt, we talk about equity, we talk about prefs. Let me put prefs aside. Now, the debt capital is considered less risky than equity. And I explain. Because you see, the company is obliged to honor its obligation to debt holders. In other words, if the company goes for a bank loan, you are obliged, okay, by law to pay your interest and repay the principal. You are obliged to do so. But when it comes to equity, the company is not obliged to repay the equity capital back or to repay or to pay dividend. The company can declare dividend if they want to declare dividends. But again, while the company can decide what to do, the company cannot control how investors view them or view their decisions. That's very important. Now, because of the lower risks associated with debt, and including the fact that it's tax deductible, debt tend to be less risky or tend to be less riskier than equity. And I explained that earlier. Now, so when we're talking about cost of debt, what should be the cost of debt? Oftentimes when I look at these things and I have conversation with people, and they talk about cost of debt, and they will go and take maybe a loan taken by the company a year ago or 6 months ago, and they look at the interest rate on the loan and they say this is the cost of debt. That's not correct. You see, when we are determining the value of a company, we are looking at the market value. We want to come up with the fair value or the market value today. And every decision we'll be making are futuristic. The decision is futuristic. We are looking at, like, for example, decisions about cash flows are all going to be futuristic. So therefore, decisions about discount rate must also be futuristic. So the discount rate we use to discount those cash flow must reflect future conditions, not conditions in the past. So when a loan or when a bank, let's say a bank went for loan a year ago, the interest rate prevailing that time was reflecting economic situation as at that time, looking into the future. So that is irrelevant today. May not be relevant today because things might have changed. So you cannot go onto the bank's or a company's financial statement. Here, I'm not really talking about a bank yet, right? You cannot just go onto a company's financial statement and then you find that the interest on the loan is 16%. So when you are doing your calculation straight away, interest on debt, 15%. No. That is not economically correct because those are historical rates. The rate must reflect current market condition and must also not reflect only current market condition, but must also be long-term oriented. Think about it. Suppose currently we want to calculate what would be the cost of debt, and I look on the market and I see that the short rates are really high as it stands. Short rates are very high. Kind of like if I say short rates are very high, you're looking at the 91-day treasury bill, the rate is extremely high, blah, blah, blah. And I look at that, I was like, okay, so I'm one to form capital market expectations around issues of risk and all that. I'm not going to go and be saying that, oh, because rates are high, rates will be high forever. And I'm not going to look at periods up to 91 days. I have to look at period beyond the 91 day. So I may end up coming out with a cost of debt that may even be lower than the existing 91-day treasury bill. Okay, so it's not something that you just look at short rates that are very high now and then conclude that that is the cost of financing anything. Or it's not like you're going to use some historical rate and that becomes your cost of debt. No. That's not true. Now, there's a model we have to be working with. We call the cost of, I am calling this here, the cost of debt model. The cost of debt model is that the cost of debt is the risk-free rate plus credit spread. We established on Friday that to get the cost of anything, okay, or we need to look at the cost with no risk plus the price for risk. And that's what I told you. So when we're looking at returns to investors, we must look at the return that investors will get if they are taking on no risk plus the extra return they'll get for taking on a certain level of risk. So if you look at it here, you'll see that the return on debt, which is also the same as the cost of debt, and I'm going to be using the ROD, return on debt, to mean cost of debt throughout, is equal to the return associated with an instrument that has no risk plus the compensation for taking on risk. And whenever we talk about debt instrument, and we're going to be looking at things this way. The risk-free rate here is reflecting the return on a stock or on an instrument that has no credit risk. And then we add credit risk to it. So it also means that the risk-free rates here may have other risk premium in it. It's not entirely riskless, ladies and gentlemen. What I'm saying is that it is default risk-free. It has no default risk. So when we take the default risk-free, we then add a credit spread to compensate for risk. And that is what we use to determine cost of debt. So we call the risk-free rate the benchmark risk-free rate. And we looked at how to estimate it. We also looked at how to estimate credit spread. And especially credit spread on sovereign. Well, that's what we did. We didn't do credit spread for corporates. But the interesting thing is that this lecture or this program will not cover the estimation of credit spread for corporate. And I'll tell you why later. So we looked at that of sovereign. earlier. So the credit spread is compensating investors for the risk of the issuer of the debt defaulting on its obligation. Great. Let me check the chart. If there's any question, no question, I can move on. Now, coming to the second component of the WACC, which is equity. If you look at the cost of debt model we have here, you realize that the cost of debt model is the risk-free rate plus the credit spread. That's what we have here. Now, so we are building the cost of debt, or we are building the return on debt, starting with the risk-free rate, and then we add something. That's the reason why last week we started with risk-free rate. Here, we are going to do the same thing. You see that we're still starting with the risk-free rate, but then we end up adding something in a bracket here. We can call that equity premium or extra premium for equity risk. If you look at what we saw under the cost of debt model, we have risk-free rate plus a premium or a spread that is compensating for credit risk. But when we come here under the equity model, we are dealing with a risk-free rate plus a spread or a premium or a margin that is compensating for equity risk. So these are two separate things: equity risk and debt risk, or debt risk is what we call credit risk. Now, it is very important for us to know something here. This is a general model. This is not a specific model. So this is a general model for cost of equity. And you don't have to get it twisted now, because we are going to look into this thing. By the time we are done, your understanding of this will be amazing. This is the general model for cost of equity. There is risk-free rate plus something in bracket, which is compensating for equity risk, for bearing equity risk. Now, the ERP is the equity risk premium. The equity risk premium. And the equity risk premium is the market risk premium for bearing this. Don't worry about the terms if you don't really get it yet. Is the market risk premium for bearing the systematic or undiversifiable risk of investing in equities in general. If we invest in equity, what extra risks are we taking on? But then the kind of risk we are dealing with here is not all the total risk associated with the equity. The kind of risk we are talking about here is that portion of the risk that cannot be done away. Even if you hold a portfolio of several stocks, that aspect of the risk will still remain there. We call it the undiversifiable portion of the risk. And the return associated with that is the equity risk premium. Now, the CSRP, which we call the company specific risk premium, is actually an extra premium for bearing the diversifiable component of the risk. You see, so there is one that is bearing the undiversifiable component, and there's another one is a return for bearing the diversifiable component of it. And a CSRP, and specific from company to company. I want to stop it here because we're going to be going into these things later. As it stands now, I'm just introducing them. We've not yet started the actual lecture for today. I'm showing you the models that we will be exploring for the rest of the session today and tomorrow. We'll explore the equity model in depth. Let me check this side here. Can you please provide a formula for the credit spread for sovereigns I'm so sorry. I don't know why I dropped off. And please, can you see my screen? I dropped off, and I don't know why. Please put something in the chat to show that you can hear me. If you can hear me clearly, and you can also see my screen, please put something in the chat. Yes, we can see your screen. Yeah, it's visible. Can you hear me too? Can you hear me? Okay, good. All right. So I was responding to a question on sovereign credit spread. So I told you that you take if the company has a euro bond, you take the yield on, let's say, a 10-year, or depending on the maturity period of the euro bond, you take the yield on that, and the yield on the comparable maturity period, a comparable uh, government instrument or government instrument with similar tenor issued together with that, or maybe around the same time, you subtract the two, and that gives you the credit spread. Or another way is to look for in the CDS market, the credit default swaps market, and you can get a price for risks there. And another one I talk about is the use of the Damodara model, right? And so you can check the videos on the lecture we had on Friday on YouTube. Somebody say if the current interest rate on debt is not the best estimate, estimating debt value, is it because we operate under the assumption that debt can be refinanced easily? Let me take it again. If the current interest rate on debt is not the best estimate for debt value, is it because we operate under the assumption that debt can be refinanced easily? I don't really get it, Ruben. If you can come again, I'll love that, so I can respond to the question. Gladly respond to. I didn't really get that. And Mamle said, when we were doing risk-free rate, we determined that the true risk-free rate for countries that have a higher default rates, we need to subtract the sovereign spread. So now with calculating return on debt, when we add back the credit spread, are we sort of undoing what we had done with risk-free rate calculation? No, we are not undoing it. All we are doing essentially is this: the yield on the government instrument is not risk-free. So when we back out the sovereign spread, here now we have risk-free rate. So if any company wants to determine cost of debt, it's a matter of the company adding back a credit spread equal to, or the credit spread to compensate investors for buying the bonds issued by that company. So the credit spread will reflect the condition of the company in question. But the sovereign spread was deducted. And sovereign spread may not be the same as credit spread. And trust me, in most cases, sovereign spreads are lower than credit spreads. If I say credit spreads here, look at it, the word credit spread. I'm talking about corporations, not government, right? So we are not undoing that. Okay, so I think I can proceed to the next slide. Interesting questions. I love them. Keep the questions coming. Let's look at this now. So I think there's a question. Let me check something. Is there a question anybody's asking? Yeah, so Ruben said, you said earlier that for forecasting, we need to be futuristic. Hence, historical debt rate is not the best. In my opinion, I believe that if a company can now easily refinance, then the historical debt will be same for an existing. But look, if Ruben, if the company is coming to refinance, is it going to refinance at the same historical rate, or is going to refinance at current rate on the market? If I got your question right, if the company is going to refinance its existing debt, it's not going to do it at the rate that it acquired the debt earlier. It's going to do it now at the current market rate. But don't forget, even that rate may not be fair, because it may be a negotiated rate, it may be a discounted rate, and that may not reflect investor circumstances. See, when we're doing valuation, we want to determine a value to an investor, and the investor has some characteristics. The investor is going to look at the price of risk in general, not just specific to a certain company alone. or be favorable to a certain company alone. So even if a company has debt on its balance sheet, the interest rate it recently even got from a bank may not be at the fair value, may not be the fair interest rate on the market, right? Yeah. The question say cannot refinance. You said earlier that for forecasting, we need to be futuristic. Historical is not the best. In my opinion, I believe that if a company cannot easily refinance, then the historical debt will be same for an existing debt. Oh yeah, if the company cannot easily refinance, you will continue to have that historical rate and be using it for accounting purposes. And that is correct. There's no problem with that. But when we want to do a valuation or discount or get a discount rate, the argument here is this. Look, when we get to the valuation, you get to understand more why things must go that way. But the argument we are making here is that if investors today want to borrow money and buy the company, will they borrow the money at that historical rate? They will not. Okay, so if you want to set up the same company today by borrowing the same amount of money to buy the same value of assets, you won't be borrowing it at that historical rate. You'll be borrowing it at the current market rate. Therefore, that's the reason why the book values of the balance sheet are not reflective of the market values. In fact, I'm not coming to get into this. However, let me just say this. When we are doing valuation, even the way we treat debt, in fact, the total amount of debt on the balance sheet, that is not what we use. We don't use the book value of debt on the balance sheet. We have to revalue the debt on the balance sheet. In fact, in the revaluation of the debt on the balance sheet, we will have to adopt an alternative approach. We won't say that, well, if I use, let's say, free cash flow to the firm, I determine the value of the company, then I need to deduct the value of debt. I won't just go and take the debt on the balance sheet and deduct. I must use the market value. And you'll be wondering, how will you get a market value of a bank loan? Yeah, there is a way. It has to be estimated. The market value of a bank loan will have to be estimated and then used in the analysis. So everything must reflect current condition. And that's the reason why the book values on the balance sheet is different from the market value, because the book value is historical. The interest rates used to amortize those debt down on the balance sheet are historical. So it must reflect current condition, because investors are going to borrow today, maybe borrow the same amount to refinance the company. They will not borrow it at the historical rates. I believe I answered the question. Okay, great, thank you. Now, the session we are looking at now, when you look at what I put here, here, I said the question is, or the statement here is, why weighted average cost of capital is irrelevant for banks? Why is it irrelevant? Why is it useless? Right? If I should put in that, why is it useless? Now, so why WACC fails for banks and what to use instead? That's what I want to talk about here. Here, my slide is a little busy, but let me explain some things to you. Let's look at the balance sheet here. I'm trying to write balance sheet. My people, let me just correct that quickly, so that it doesn't look like I came here to I was presenting a balance sheet, a wrong balance sheet, or maybe I'm giving another name to it. So bank, that's just a typo. So bank versus non-bank balance sheet. Let's compare the two. This is just an extract. If you look at a manufacturing company, let's say we have a manufacturing company that has some bonds as debt. So some corporate bonds issued as debt. And so that's like 30%. 30%. But let me check. I think there's a question. I don't know if it relates to the earlier. Check your spelling of commercial. Thank you. Now, I can just imagine. In fact, let me just say, I'll correct these things before they send the need. They'll send all the notes to you this evening. I think, they'll look at that. All right. Now, so let's look at debt. Manufacturing companies. So let's say the manufacturing company has its capital in this form, 30% from debt and 70% from equity. And let's say 30% is bond. It can also be bank loan, right? But I don't want to use bank loan because I don't want to confuse you with the commercial bank. So 30% bonds, but that's debt. And 70% equity. When we come to the commercial bank, let's say we have in fact, the largest liability on a commercial bank balance sheet is is deposit. So let's say the deposit takes 90% of the debt and equity is just 10% because banks are leverage businesses, right? They use leverage. Now, when you compare the manufacturing company and a commercial bank, you see that the bond they have is for financing purposes. The bond they have is being used to finance the business or to finance the asset. In other words, it's being used to finance long-term, let's say, long-term operations, or is for financing. That's the reason why when you take the cash flow statement of a manufacturing company, you see bond under financing activities. It's not part of operations. It's a financing activity. When you come to the commercial banks, the business of a commercial bank here is to mobilize deposits and grant loans. So it's actually part of their operation. So the debt here, which is the deposit, is operations. It's not for financing purposes. It's for operations purposes. That's the reason why on a cash flow statement of a bank, you see deposits under operating activities and not under financing activity, right? Now, so note that in mind. So the deposit for a bank are like raw materials, like inventory. They are like raw materials for a manufacturing company. Okay, now, and that is not capital. That is not capital. So deposit is not a capital for a bank. It's part of operations. I understand that banks can float bonds. Okay, and when they float bonds in that manner, of course, the regulator sometimes in the computation of the capital adequacy ratio, they may allow for those bonds to be treated as a tier 2 capital. But deposits here are the major item on the bank's balance sheet, and it is not capital. It is not capital, and it's not for financing purposes. It's for operations. Now, if that's the case, that's been well established. Let me see. I think a question. I want to be taking the questions right away. How do you treat tier 1, tier 2, etc. debt? Okay. Well, I think here any debt at all you see for tier 1, of course, you're not going to really see much of those debt. But then whichever debt it is capital, it's part of capital, and that's correct. But I see, Douglas, the challenge here is that the bonds on the balance sheet are not the dominant source of capital. They are not dominant. They are not dominant on the balance sheet. The debt are not dominant on the balance sheet. So because they are not dominant, you tend to even ignore them. Because the most dominant debt instrument, liability on the balance sheet, is deposits and not bonds. Bigger side of the pie, rather than focusing on the smaller thing. Because think about it, how many banks even in Ghana have bonds? How many banks have their balance sheet? So it's actually deposits that they are using. Okay, and the deposits are being used in operations. Okay, now that's been established from the perspective of the balance sheet of a bank and a non-bank institution. That's been established. We can now attend to a problem here. So the WACC problem. So here I want to talk about the WACC problem. The first problem is the WACC assumption. According to the WACC assumption, debt is a financing choice. So meaning a company can decide to take on debt or decide not to take on debt. So Douglas, this is where you see the distinction clearly. A company can decide to take on debt or not to take on debt. And that's a decision that industrial corporates can make. Okay, but a bank cannot decide to take on deposit or not to take on deposit. So from the word go, the basic assumption under WACC is being failed. So banks must take deposit to exist, and that's their business model. That's why when we started this, we started by looking at business model. That is their business model. Banks must take deposit to exist, and that is their business model. But corporations can make a decision on whether to take on debt or loan, or not to take on debt or loan. But banks cannot make this decision. Banks' primary business model is to actually take on deposit. That's the primary business model of a bank. And there's no two way about it. That's the first one. So you see that the assumption is violated. The second item here, the miss. Now, if you check a typical balance sheet of a bank, you see that the deposits are often higher than the value of equity. The deposits are often higher than the value of equity. So that case of deposit being higher than value of equity, for example, look at a situation that we have here. Equity is 10% on this commercial bank balance sheet, and deposit is 90%. What is likely to happen is that you are going to, when suppose you are doing this, you are calculating WACC, you are going to be overweighing the cost of debt, because the cost of debt is about 90% weight, and equity just have the weight of 10%. So you underweight, you end up underweighing equity, as though equity really doesn't matter. Meanwhile, equity is there are serious issues associated with equity in the banking sector. Think about what the regulator is concerned about is equity. The regulator is almost concerned about the equity capital you have. Everyone is concerned about equity, because if a bank to collapse today, it's about the equity. And we established that in the first lesson, the first day. The Bank of Ghana will be so much concerned about whether your capital adequacy ratio is breached than to say whether you have mobilized so and so amount of deposit. That one is a business decision. But the regulatory decision here, or the regulatory action that could be taken against you, is not against whether you have enough deposit or not, but it will be against whether your capital is sufficient to support the risks you want to take in a form of granting loans or risky loans. Okay, so if we should go ahead and say we are still calculating the weighted average cost of capital for this bank, we may end up taking, let's say, deposit at 90% and equity at, let's say, 10% and underpriced equity risk. And that is risky. The last point I want to make, tax shield. You see, what we're discussing here, it will be difficult for you to have this in your classrooms, in the universities being discussed. These are very, very practical things. So you got to take advantage of these things, especially taking advantage of things that, or things that are free. Sometimes people don't value them. People value things that they pay for. But imagine the society organizing this, and imagine taking on time like this to prepare all these slides for you. Okay, spending my time to get all this for you. You need to take advantage of it, given that it's free. Tax shield is the last one. You recall when we're talking about cost of debt, we say that the interest accrued on debt is tax deductible. Or in other words, there's a tax benefit associated with it. It doesn't work with banks like that, because the deposit cost, which is the interest expense on a bank's P&L, are operational. They are not for financing purpose. Therefore, there's no tax advantage associated with them. No bank banks deduct interest expense before calculating profit. However, the treatment of the interest expense is not in a manner that is being used for financing. The interest expense is deducted because it's an operational item and not because it's a financing one, right? So that's why things like capitalization may not apply to a bank, interest expense in that sense, right? So the deposit costs are operational and they are not tax advantaged. Because we can have, because the reason why, again, you should think about this, that they are not tax advantaged, is that a bank cannot say, I won't take on deposit, because the primary business model of a bank is to raise deposit. So you can't even say you won't take on deposit to start with. So every bank has a deposit, so none of them is advantaged. The only advantage that may come is that, well, I have competitive advantage in mobilizing deposits from cheaper sources like CASA. But apart from that, you are not advantaged because you have deposit and I don't have deposit. Therefore, I'm paying a lower tax. No. But when we look at it in the context of a manufacturing company, We have those advantages coming out because debt is used for financing purpose, and it's a choice a company needs to make. The company can decide to have debt, and it can decide not to have debt. I hope that is very clear. That is very, very clear. Why WACC is irrelevant for a bank. No question in the chat, and I believe you guys are enjoying it. So far, I believe you're enjoying it. Now, so if WACC is not appropriate, then what is appropriate? Well, the right tool to use is cost of equity. So when we deal with banks, we limit it to the level of cost of equity. Why? Number one, equity is the only investor capital. Now, when you look into on a bank's balance sheet, they take a lot of deposit. That's not an investor capital. The only investor capital here is equity. So why are we determining the value of the entire firm, or the value of the firm, the value of debt and equity? Why are we doing that? There's no need doing that because equity is the only capital here. So that's the reason why we are doing that, for only equity. So why not concentrating on the cost of equity? Two, discounted equity cash flow models align with residual claim. In other words, what is important when we are looking at a bank's value is what is left when we sell the asset and pay off all the depositors. You see, when we liquidate the bank's assets, the loans, everything, the physical assets you see, the investment securities, when we liquidate them and we pay off the depositors and any other liability, what is left is a residual interest. And that is what the investors are concerned about. If there's a run on this bank now, the bank is to collapse, how much will be left to me? And that is what we're thinking about. So the discounted equity cash flow models align with residual claim. Then another one. The third one is that the use of cost of equity reflect the true risk. The true risk is not the cost of debt. No, because even a lot of the deposits mobilized are mobilized at no interest, like current accounts. Current accounts count at no interest, right? Now, so cost of equity then becomes the true risk. Okay, and what are the measure of the true risk? And what are the true risks? Number one, volatile earnings. And I indicated earlier that bank earnings are very volatile, right? Macro shocks, the shocks, macroeconomy, interest rate, inflation, exchange rate, GDP, even government actions like the defaults and all that DDP hits on the balance sheet of bank. Why does it affect? It goes to affect the equity capital. So equity, the use of equity is the best here. And also regulation. Regulation is concerned about equity. That's why the capital adequacy ratio has to do with equity. That's why tier 1 capital is prioritized over tier 2 capital. And look, the Bank of Ghana or the regulator is concerned about equity, whether you have enough equity to absorb any loss, any potential loss. That's the essence of banking, right? Or risk management banking. Great. Let me see. Does it mean the weight of equity will be calculated again? No, there's no need for weight of equity. Oh, once we determine cost of equity, that is all. What we are going to be doing, Kweku, is that we are going to determine the cost of equity, and also we will determine the cash flows that are attributed to or attributable to equity holders, and then we will discount those cash flows as the cost of equity. And so there's no need to do any weight calculation again. Ivan is saying, what about a parent company giving a loan to a subsidiary bank? A parent company giving a loan to a subsidiary bank. Well, and who wants to calculate? And we want to calculate the cost of equity of this. Number one, to state, even that loan that they are giving to the subsidiary bank is not at fair value, because once a parent company is giving a loan to the subsidiary bank, they're likely to give it either at a rate very high just to absorb, quote and unquote, that implied dividend payment that, or, when they do that, they know that the interest expense will go to the P&L, blah, blah, blah. Therefore, the GRM will not attack them or whatever. So they just want for dividend to be declared outside a regulatory limit. Bank of Ghana has some restriction on declaration of dividend. So it's actually a strategy. So the whole idea is a strategy. So if it's a strategy, nobody cares about that. Given that the parent company is giving loan to the subsidiary, nobody believes that loan is even at fair value to even start with. So you don't even care about that much. Let me see any question. Now, so we've answered the question why the WACC is irrelevant for banks. That's the question we're trying to answer so far. and we've done justice to that. Let's put something in the chat. Let me see. So far, if you are enjoying the lecture and if everything is clear. Yeah, so put something in the chat to show that you're enjoying the lecture and everything is clear. Let me see something in the chat. Very clear. Good. Let me see about 4, 5, 6. 6 other responses. Yes, Julius, everything is clear. Very insightful. Great, great, great. Mami Fua and Mamle and Nelson, all correct, sir. Great insights so far. Mark Jordan. Great, great, great. Wonderful. Now, so we've answered the first question. Everything is clear, Sam. Now, thank you, guys. Yeah, Georgina. Thank you. All right. So now that we've answered the first question and we've established that WACC is irrelevant for banks. So anyone you see calculating WACC for bank, ask the person question, why WACC? Let the person justify the use of WACC. And let's see how the person will go about justifying the use of WACC. And of course, you'll be happy to tell the person the new story, right? Good. Now let's proceed. What we're going to do, now that we've established that cost of equity is the most relevant methodology, the rest of the lecture through to tomorrow will be concerned or be concentrated on cost of equity. Formally, when I'm teaching discount rate, I use a minimum or a maximum of about 8 to 9 hours to teach discount rate. And that means that I'm going to teach risk-free rate, I'll teach cost of debt, I'll teach cost of equity, then I'll teach the weighted average cost of capital. It takes me, on average, about 9 hours. But the pace that I'm taking this on, if I'm to do the same, it may take me like 10 hours to complete. The reason is that these things are not very that easy. And I mentioned to you that in your universities, or when you do your courses, or some of the professional exams you might have taken, you will be introduced to some of these things, but the way and manner that you'll be tested on, you may never understand it. You will just know the theory that is never useful. So you end up preparing research reports and be calculating some of these important metrics wrongly, making the wrong assumptions. And that's the reason why learning these things now is very important. Now we're going to continue with cost of equity. I'll get to a point today and stop it. Then we'll continue tomorrow. We'll end it tomorrow. Cost of equity. Let's talk about some preliminary concepts on cost of equity. Now, I want us to revisit some basics. So we stated earlier when we started the whole lecture that cost of equity actually represents the minimum return that equity investors require to own a company. So if I said to own a company, it means to own the company's stock or to buy a share in a company. So what is that minimum return that a company can promise that investor that this return, I am going to buy shares in your company, or I'm going to invest in your company, or I'll become a shareholder. What minimum return can you promise? So the question of what investors value will help you to understand what they consider as a minimum return. Then is the same as minimum return required to justify the company. The minimum return required to justify investing in the company. Now, in the earlier slides, when we began the lecture for today, we talked about the cost of equity model. And I showed you the cost of equity model. When you look at it, and I said the cost of equity model is presented as follows. We have the return on equity, which also is the same as the cost of equity, to be equal to the risk-free rate plus a set of premium. Now, let me clarify something before I proceed. I tend to use the word cost of equity and return on equity interchangeably. The reason is that it is a cost to the company, but it's a return to the investor. In an efficient market, we expect both the company and the investor to speak the same language about how they consider as return. Therefore, cost of equity is the same as return on equity. The RF we know is the risk-free rate. Do we know how to estimate it? Yes. We have already looked at it in the last session. That was on Friday. We looked at how to estimate risk-free rate. We spent 2 hours doing that. The second term, ERP, is the equity risk premium. And that is up next. That is what we're going to do next. So the lecture is such that you will be taking each of these. You take the ERP, you take the CR, like that is what we're going to do to complete the entire model, or the entire lecture by tomorrow. The CSRP is the company-specific risk premium, or the idiosyncratic risk. The company-specific risk premium, or the idiosyncratic risk. And that is the risk specific to the company. And that is the risk that cannot be diversified away. So the return, the risk that can be diversified away. So the return associated with that risk is what we call the CSRP. But the ERP is the return associated with the undiversifiable aspect of the risk, which we call the systematic risk. So again, I'm stating that the return on equity model we have here is a general one, right? It's a general one. We've not started talking about CAPM or anything. Put those things aside. We're building a case. And you need to start learning things from this angle. Most textbooks jump and they start prescribing models. No, it's not appropriate. The best thing to do is to understand the foundation of equity risk pricing. Then from there, we now see how the argument now leads us to those equilibrium models, right? You'll get into those later. Let's talk about equity risk premium. Now, what is equity risk premium? You see, when we talk about equity risk premium, I made a mistake. Let me correct something quickly, guys, in my slide before somebody picks it up. And I don't know what's happening to my cursor. Just a moment, guys. My cursor is kind of messing up. I've taken off my screen so I can address. There's an error in my notes I want to quickly correct. It's a significant one, so I had to correct it before. I just spotted it. Sometimes when you're preparing these things, and I don't know, if you're not careful, you just make mistake. Okay. I hope no one spotted it. All right. So when we say equity risk premium is the extra return you would demand to move your money from a risk-free investment into stocks. Suppose you have some investment, and let's say for now, in this argument, let's just consider Government of Ghana instrument as risk-free, just for argument purpose, right? Just for argument purpose. Not because they are risk-free, but so that I can just make a point, right? Okay. Now, let's say you have some money in Government of Ghana Treasury bills, and somebody wants to convince you to move the money into stocks or to invest in, let's say, a stock mutual fund. To invest in a stock mutual fund. Currently, the money you bought some treasury bill. Then the question you ask yourself is, what will be that extra return I'll make above what the government is giving me? Because we are considering the government instrument as risk-free. So if you're now asking me to move the money from a place where there is no risk to a place where there's risk, I'm going to ask you, what return can that place give me? What return can that place where there is risk give me? What additional return will it give me above what I'm getting now from the government, or above what I'm getting now on the investment that has no risk? And that is what we call the equity risk premium. The extra return you will demand to move your money from a risk-free investment into stock. That's the equity risk premium. Okay. Now, that extra return investors demand above the risk-free rate as compensation for holding the equity securities rather than the risk-free asset. And that's what I've just explained. So if you look here, this is the equity risk premium. It's just the change in the formula. But you notice something. On the previous slide, when we have the return on equity plus RF plus ERP plus CSRP, we then drop the CSRP for a moment. So guys, I am dropping the CSRP for a moment. Later, things will become clearer as to why I even dropped this now. I'm dropping the CSRP so I can explain a concept. We'll bring it back later. Now, so if I drop the CSRP, or in other words, what I'm doing is that I'm assuming that the CSRP is 0. If the CSRP is 0, then you know this is how the formula was simplified to. It means that the return on equity minus the risk-free rate will be entirely the equity risk premium. And don't forget how we define equity risk premium. We define equity risk premium as the return or the extra return we are getting above the risk-free rate to compensate for the systematic aspect of risk, or that aspect of risk that cannot be diversified away even by holding a portfolio of instruments. I want to take my time later to explain to you, maybe tomorrow if I have extra time, to show you some of these things. I'm going to show you some of these things, but there are things you read or you often read in textbook, but I'll show it to you, I'll prove to you that it's correct. To say that if you can diversify away your risk, your unsystematic risk will be 0. I can show that to you because I tried it, I tested these things before. I'll show a bit of that to you. I'll start the argument from today, and maybe tomorrow when we have time, I'll show it to you more, because that is very important for portfolio management purposes. And those of you who are in portfolio management or who may be in risk analytics, portfolio risk analytics, and maybe you want to decompose equity return or the return on the portfolio, you want to decompose it to look at the component of the return, or you want to decompose portfolio risk, and you want to see the component of the risk that is driven by the market, which we call the systematic risk, and a component that is company specific, which we call the company specific risk. You want to do that risk decomposition. It's quite a hard job, right? It requires some level of mass, and by extension, it requires some knowledge in advanced linear algebra. You have to use matrix algebra and to do the risk decomposition. It is not that difficult. It's not that difficult, but just that it's quite difficult for people, especially if, let's say, you're doing the portfolio risk decomposition, and this involves not just assets within your country here, but it involves cross-border investment. Like you have some investment in stocks in Ghana here, you have some stock in US, stock in China, stock in whatever, and you want to decompose the risks, then it means that other risks are coming in. And you have to compare, you have to, look at the covariance matrix or covariance across all the asset classes. And it's quite a daunting task, okay? But maybe later later in the year, I may do a webinar on portfolio risk analytics, and where I'll use mathematics. There's no math, right? Now, so when we take the risk-free rate from the return on equity, we get the equity risk premium. Now, so it means that if we can estimate the return on equity and we know the risk-free rate, equity risk premium is not going to be anything difficult for us to do. Now, so the discussion on the market has not been about the risk-free rate. It's about what is the equity risk premium. Because if you can know the equity risk premium, risk-free rate is just given, right? So, and there are several views around equity risk premium as to how it should be estimated. It's actually very difficult. And because of the difficulty associated with doing it or estimating it, there may be diverse opinions among analysts regarding the value of a business or stock. Because think about we use the equity risk premium, we place it, we add it to the risk-free rate to get a cost of equity. So, and we use that cost of equity to discount the cash flows to get a value of a company. So if we are wrong around that, if we are not able to get a correct equity risk premium, then we may end up incorrectly valuing firms as well. Okay, value stock and making wrong investment decisions. That is established. Any question in the chart? Nothing. Let's proceed. Now, we just look at this basic concept and we revise our notes on this basic concept. We are now going to get into it, how we estimate equity risk premium. So how do we estimate equity risk premium? Well, this is not that easy. As I said, it's not actually an easy task. But let's see how it goes. How to estimate equity risk premium? There are generally two methodologies that are employed. I think there's a question in the chat. Let me just check that. Where do you obtain the return on equity from in estimating the equity risk premium? Oh, Martin, so what happened is that this, let me put something here. The return on equity, how we get it, that's the essence of the lecture actually. And we're going to look at how we estimate it. That's the essence. Good. Estimating equity risk premium. Because we know to estimate the equity risk premium, we need to get a return on equity minus risk-free rate. And we have already talked about risk-free rate, so that's not the argument for today. The argument for today is on the return on equity, right? Let's get into it. So how we, it's on return on equity, yes. But how do we then calculate the equity risk premium? Don't forget the model. To get equity risk premium, we get return on equity minus risk-free rate, right? So when I ask you that, how do you calculate equity risk premium? By implication, I'm asking, how do you calculate return on equity? Once you get a return on equity, getting equity risk premium becomes easy. Now, you need to pay some attention here. There are two ways calculating this. One is looking back into the past and calculating the return on the stock based on the stock history. So we go back into the history, we download stock data, maybe daily stock data or weekly stock data over the last 10 years. Then we calculate returns. That's one way to handling this. You calculate the returns and do our manipulation. We'll get back to that. Once we do that, we'll come up with a return on the stock. We'll look for an appropriate benchmark risk-free rate, subtract it out of it, and that gives us the equity risk premium. That is easy. The second side is not that easy. And when I say stock return to, I'm not stock data to, I'm not talking about stock data of a company. No, I'm not talking about that. I'm talking about stock data of the market. Okay, we're looking at the return on the equity market, not the return on a company. That's not what we're doing here. That's the reason why, you see, whenever we forming capital market expectation, we are not forming expectations for an individual asset or so company stock or whatever. No, we are forming a broad market expectation. How will the S&P perform? How will the Ghana Stock Exchange Composite Index perform? Right? Like, that is what we're doing. Forward-looking. The forward-looking approach here, it focuses on expectation and projection rather than past stock data. It's about what is likely to happen in the future, not what has already happened. So here, analysts are likely to consider macroeconomic and market factors that could impact risks and return in the future. So it's futuristic, while the historical approach is historical. Now, let me say this before we proceed. When we're discussing cost of debt, I said that the yield on debt or the cost of debt must reflect future circumstances. Therefore, you cannot be using historical interest rate as cost of debt. And I told you it's wrong. Then the same person here, me, saying that to calculate equity risk premium, which is supposed to have been forward-looking, I am now saying that you use historical stock data. Am I not making a mistake? Well, let's see whether that is true. There is an assumption that we will be making before we use the historical data to calculate equity risk premium. Now, when we use historical data to calculate equity risk premium, what we are trying to say is that the return earned in the past, okay, is likely to repeat into the future, or past returns will occur again in the future. That's basic assumption. We're going to get into it. Good. This is the slide on the historical approach. Let me grab water. Okay. On a historical approach, you see, the historical approach is perhaps the most popular approach that is used. What it does is that it uses it uses historical stock data and then calculating the returns on that. So you use the historical approach when reliable long-term equity return data are available. In other words, when reliable stock data is available, and then that hits on the question: is the use of Ghana Stock Exchange data reliable? Is the GSE CI reliable? Can we use that index? Not really. Not really. In fact, because of the things I want to cover today, I don't want to talk much about the Ghana Stock Exchange market and the relevance for some of these things. I will want to talk about that tomorrow, but the use of the Ghana Stock Exchange index is not relevant. It's not relevant. And it's sad because there's low trading activity on the market, coupled with several factors that makes it wrong for the use for estimation of equity risk. You know, we'll talk a lot about that later, but just take that for now. Okay. Now, so how does the historical approach work? So this is how it works. What we do is that it is calculated actually, the equity risk premium is calculated as the difference between the broad-based equity market in the broad-based, and the GSE is not even broad-based equity market index. Okay. Equity market index return and a benchmark risk-free rate over a sampled period. So you see some few things here. We have the broad-based equity market index, and we need to determine what the broad-based equity market index should be. The second one is a benchmark risk-free rate. So we need to determine what the risk-free rate should be. So we know when we get a return on equity minus the risk-free rate, it gives us the equity risk premium. But then we need to do this assessment or this calculation over a sample period. And then the question you ask is, over what sample period? Is it over a 2-year historical data period, or 3 years, 4 years, 5 years, 6 years? We'll answer those questions soon, right? I think there's a question here. It said, why do you... Okay, so looking forward to the discussion on why GSE isn't reliable. Yeah, we'll discuss that tomorrow, actually, in details. I want to take my time to cover a lot today. We'll discuss that because tomorrow, God willing, I'll get into some regression things, and we'll have some of those questions answered. Great. Now, key assumptions implied in this. So the whole thing is that when we're using the historical approach, we are making two assumptions. Number one, historical returns are independent and identically distributed normal, or we call it IID normal. The returns are IID normal. If you have never heard about IID normal before, I have to spend my time explaining what we mean by IID normal, because the assumption of IID normal, it underlines a lot of things we do in finance. If the returns are not IID normal, we can't do some calculations that you and I will be doing. Perhaps you've been doing it, but I didn't even know that you were able to do them because the returns are IID normal. If the returns are not IID normal, the use of those calculations are going to be baseless. And the question is, are the returns actually IID normal, or we are just making assumptions around the returns? Now, let me break down these points. I think I can get a whiteboard here, right? let me check if there is a whiteboard so I can do some drawing. A whiteboard. I think there's often a whiteboard on Zoom. Camera, video, PowerPoint as background, document, file. Okay, there's whiteboard here. Good. Opening a whiteboard will stop the screen. Share. Do you want to continue? Yes. So I want to demonstrate something to you. When we say returns are higher than normal, and I would want you to confirm. Let the collaboration begin. I think I just need a new one like this, or use whiteboard classic. Okay. Please confirm if you can see my whiteboard. Confirm. Please confirm quickly if you can see my whiteboard. So we get into that on the whiteboard. So I show you why those assumptions. Yeah, great. Great. So when we say returns are higher than normal, this is what it means. So if I have the return on the 1, I'm going to be drawing, so my hand is going to be irregular, right? The 1 return and the 2 returns. The 2 returns. Now, and let's add the 3. The 3 returns. What is happening is that if I calculate the return on the 1, sorry if I say the 2, I mean the 1 stock price, the 2 stock price, the 3 stock price. So if I want to calculate the return at the end of the 2, the return at the end of the 2, you know how we do it. Let's do a simple return calculation. The return at the end of the 2 will be the return at the end of the 2 divided by, so the return at the end of the 2 divided by the return at the end of the 1, then we subtract 1. So this is a simple return formula. Simple returns, simple daily returns. So that gives us a return for the 2. And we can do the same for the 3. Now, if you and I, we sit, I mean the price, the stock price at the end of the 1. Am I still saying return? Guys, stock price at the end of the 2 divided by stock price at the end of the 1 minus 1. That's what I mean. I'm so sorry. But thank you very much. Now, this is what happens. Let's say we are in the 1, at the end of the 1, and we ask ourselves a question. What will be the return on the 2? You see, we are currently at the end of the 1 by close of day 1. And we're asking question. It is uncertain what the stock price will be by close of trading day 2. But can we come up with the return, the possible return at the end of trading for the 2? Or let me take my words back. Already we have stock price for the 1, the 2, the 3. So let me use D4. Great. Let me use D4. Let me say we are currently at the end of D4. We want to determine the stock price for the 4. By extension, we want to get the return at the end of the 4. Okay, but we are currently we've just closed trading for the 3. So what's the return for the 4? Now, so when you are currently at the 3, you're wondering what will be the return for the 4. But this is what we do. If you want to simulate the returns for each day, the simulation of the return for each day, the assumption we make is that the return for each day is assumed to be normally distributed. So the 1 return is normally distributed. So if it is normally redistributed, we can say that it has a mu of 1 or mu1 and sigma, let's say sigma also 1. So that's the 1. The 2 returns also is assumed to be normally distributed. Look, don't mind my drawing. Actually, I'm not good at drawing. And so the 2 is normally distributed with a mean of this mu2 and sigma of sigma 2. Okay, that means the standard deviation sigma 2, then a mean mu2. So these 2 returns, the return for the 1 is normally distributed, the two return to is normally distributed. Or in other words, let's say that the return for the one, this is the distribution of the return. What we mean is that this, if we look at possible returns that can occur on the one and we plot them, we will have a distribution like this. Now, what do we really mean by distribution? Let me show you this. What we mean by distribution when we draw this thing is this. Way back in high school or even junior high school, we learned how to plot histograms. So we are taught how to plot histograms. So we plot histograms, we plot the histogram up, then often you have one bar at the top or in the middle there, that's the tallest, right? If you recall. And then we locate that as the tallest, and that's where we locate even a mean, right? Now, suppose that the bar here, the bar sits in the middle, the tallest bar sits nicely in the middle. Then we'll say, oh, that's the mean, right? The mean. Now, also we learned in high school how to draw something called the cumulative, or we call the frequency polygon over the histogram. We draw it through the midpoint of the histogram, right? Through the midpoint of the histogram. Now, often when we draw it with our hand, so it's not smooth, okay? And also the number of bars we have plotted in the histogram is limited. Sometimes 10, 15 bars, that's all, because the way we do the class sizing and all that, we have limited bars we plot. So that is a discrete data. We call that a discrete data. But what we do in finance, most of the time, as far as stock data analysis is concerned, we don't work with discrete data. We work with continuous data. And let me explain here. Now, if we take each of the bars, look at it clearly. I'm taking you into something. If we single out each of the bar or a bar, we will have the length, let me call this the length, and the breadth of the bar. What is the area of this bar? The area of the bar, we know from basic mathematics, is the length times breadth. Length times breadth. Okay, that's the area of the bar. Now, so if I calculate length times breadth for all the bars in a histogram, it will give me the area covered by the histogram. If I calculate the length and breadth of each of the bars and I add them all together, it will give me the area covered by the histogram. And I believe you agree with me as far as that is concerned. Now, so it gives me the area covered. But suppose the number of bars is infinite amount of bars. The bars are very thin. The width or the breadth of the bars is extremely thin, such that the number of bars we are dealing with is infinite. But you can actually still see their height. But the number of bars you are dealing with is infinite. Then the breadth will become very, very close to zero. Now, when I consider this as S as is, and I'm looking at the breadth of the bars, if I move from one bar to another bar, and then to another bar, and then to another bar, I'm changing from one breadth to another breadth of another bar to another breadth of another bar, but I assume that all the breadths are the same. The class size is the same. Now, when I move from one bar to another, there is a change. I'm estimating a change in the breadth. And if the breadth is represented by letter S, then I'm going to have change in S. Now, if the bars become a lot, then this change in S, the breadth of the bar will become extremely thin such that it will start approaching zero, will be almost zero. Now, once it starts approaching zero, then I can apply calculus because the change in S now is approaching zero. So I can apply calculus. So now when I want to do the summation in terms of left times breadth of each of the bars and add all of them together, I may not be able to do it because the number of bars is infinite, so I can't calculate for each bar. So in infinite things, if I need to do whatever, I'm going to say that the height or the length of the bar is now F. I represent it by letter F, and the breadth of the bar will actually be delta S, which in calculus language, we write ds. We write it ds. So I am multiplying the height of the bar, or the length of the bar, which is f, by ds, which is the width of the bar. It's the same area calculation. But because I'm doing this for infinite number of bars, and in calculus, you need to use the infinite summation, which is the integral. I'm integrating this because when we now have several bars, infinite number of bars, some are into the right tail, some are into the left tail, and they are infinite. Therefore, I'll have to integrate from the negative infinity to positive infinity. And then this will give me the area under the curve. So this is the area under the curve. What are we doing here? I am talking about infinite bars. When we bring the argument back to the equity analysis or the returns we are dealing with here, we are plotting the returns, analyzing it just in the form of a histogram. So there will be millions of histograms. So when I now join I connect the tops of those millions of histograms, it tends to give me a very smooth curve that looks like a bell curve. That's how come we have the normal distribution. So the normal distribution is just the data representation in a continuous fashion, right? So when we move from a discrete data to continuous data, we have the histogram transforming to normal distribution. So when I say that we are currently on day 3 and want to get how the return will be in day 4, the distribution of return in day 4. The return in day 4 can be any figure. It can be 0.5%, it can be 1.3%, it can be negative 0.5%. It can take on any value at all. So there are billions of possibilities of what the return on the stock will be on day 4. So when we plot all those possibilities in a histogram fashion, we have this. So we can strike the middle to get the expected return. What is the expected return on the stock on the next day? And that is what we have measured as the mu1. And the standard deviation of the return is also this. Now, so in this case, we have answered one question that the return distribution is the same. So when we move from day 4, we assume that the 4 distribution is normal like this, and it has a mu of this. And when we move to day 5, we have the same distribution of return. Therefore, if the return distributions are the same, that the 4's distribution of return, what could possibly happen on the 4 is the same or identical to what is going to happen in the 5, then we say that the returns are identically distributed. They are all normally distributed. Therefore, they are identically distributed. Okay, the identical distribution is there, but it's not all identical distribution are important to us. The identical distribution important to us is the normal distribution. But think about it this way. If this is too hard for you, you move from it. So I'm just explaining I did normal. So I know this is a hard concept, but now we have this return. And if you don't understand it further, you can actually go on YouTube and watch this later. But this return or this return distribution is identical to this return distribution. If that is the case, then there's one thing we need to look at. We need to also look at whether the returns on day 4 are independent of return on day 5. In other words, will the returns made on day 4 affect the returns on day 5? Or if return on day 4 is 3%, will it affect or does it have anything to say about what return on day 5 will be? If return on the stock, let's say MTN stock on the Ghana Stock Exchange, today is 2%, does it tell any story about what that of tomorrow will be? And the answer theoretically is no. If it doesn't tell the story of what tomorrow's return will be, then we say the return on the 4 is independent of the return on the 5. Therefore, the distribution of the return here is independent of the distribution of the return here. So now, we can put all this together to say IID normal, for return to be IID normal, it means they are independent from one day to another, and they are identically distributed, and they are normal. Now, that leads us to very important thing. If this return, let me pick another color. If this return, U1 and U2 are independent and identically distributed, then if I take the return on the 4 and return on the 5, I can add the two together. Therefore, I can say that my total return is return 1 plus return 2. That's the reason why we are able to do this. Otherwise, we wouldn't have been able to do it. In other words, we can also say that the return on the, if I know only the return on the 4, I can calculate the return for the rest of the year by saying that, well, if one daily return is 5%, forget about even the 4. Let's say the daily return, the return calculated per day is 5%. I can go ahead to calculate the return that you get at the end of the year. 252 days. This, assuming we have 252 trading days in Ghana as well, 252 days. I can multiply that and say this is the annual return, because the return on every day is identically distributed and it is normal and it is independent of each other. Therefore, I can do this. Now, coming to the volatility side, which is the standard deviation, given that the returns are independent, meaning there's no correlation between the daily returns. If there are correlations, if the one returns correlate with the two return, then I have a problem. If that autocorrelation is there, then the calculation of, or the generalization of the volatility will be inappropriate. But because we can assume that the return between the days or the daily returns are independent, we can then say that given a daily return, then the annual volatility of return will be the daily return multiplied by the square root of time, or the square root of 252. We say volatility increases with square root of time, while returns increases with time. Okay. I hope that is clear. Before I go back to the lecture note again. Good. Going back to the lecture notes. Going back to my screen. Good. Now, I don't think there's any question now, but that's quite heavy for you, right? So that's what I'm saying. If returns are IID normal, then they're stationary, then the returns are considered to be stationary. When returns are stationary, it means there's a constant mean and a constant volatility. And that's what I explained to you. So if I have the returns, the return for the 1, which is it will be the same return expected on every other day. Okay, day 2 return, day 3. So the expected return on the 1 will be the expected return of the 2, of the 3, the 4, the 5. And volatility too, if we estimate volatility and we assume that independence, then there's no correlation. Then the volatility of the 1 will be the same as volatility of the 2, and then will be the same as the volatility of the 3. And then we can then use a simplified formula for this. And Kweku said, thank you for this insight. Great. Because I know a lot of people do this every day. You know, we need to understand the reasons behind the very things we do. Now, if that is the case, so if daily returns are IID normal, then the returns, the annual return is calculated as the daily return multiplied by 252 trading days. Now it depends. If you take if you go to the US market, you take all the business days, all the weekdays minus or let's do it this way. You take the total number of, or you take the calendar years, calendar days, right? 365 days, subtract all weekends, subtract all holidays in the United States, you get 252. Now, in Ghana, I think it's just a slight difference, right? I did that, but I've forgotten the number, right? Good. Now, volatility, annual volatility would then be equal to the daily volatility times the square root of time. So volatility increases at the square root of time, while returns increase with time, right? And this thing has a very important application, right, guys? When you deal with short-term instrument, that's why That's why you see that a lot of derivative products are written, short-term derivative product. They actually trade on volatility, or what actually drive option prices. I mean, option prices is volatility, right? So when you take the Black-Scholes equation, for example, you see volatility is a key component in the Black-Scholes equation. The idea is that in the short term, volatility dominates the movement in stock prices. In the longer term, returns dominate. And you can see it from this formula that you start to see the effect of equity, or you start to really see return dominance in the price, or sorry, you tend to see the dominance of returns or growth in the long term. That's why when you invest in the equity market, you are investing, and you are investing for growth. Then you must do it long term. You tend to see the growth in the long term. But volatility tends to dominate in the short term because of this formula, as it is like this. It increases the square root of time. So as time passes, volatility reduces. Or the impact of volatility, or the impact of time on volatility is lesser than the impact of time on returns. Because here for daily return, we are multiplied by 252 bar. For daily volatility, to multiply to get annual one, we are multiplied by the square root of time. So that is it here. And someone said, in practice, are daily returns already normal? NLT, that's a big question you're asking me. And that takes us to some discussion on stylish returns, right? There are a lot of research that are done around these things, and they can all conclude to you that it's not IID normal. One thing I want to tell you clearly is that equity returns are actually not normally distributed before we even start thinking about IID. And I'll show you. Let me look at the time. I think I'll show you before we close today, or if I don't show you, I'll show you tomorrow. We'll test the IID normal condition. We'll test it tomorrow, either tomorrow or today, depending on when I get there. To even test it, very easy. You just have to test whether the returns are normally distributed. And if you test to see the returns are normally distributed, all you need to check to see whether the skewness is 0 and whether the kurtosis is 3. If you don't have the skewness and kurtosis being those values, then you know it's not normal. But even though we assume that we know equity returns are not normally distributed, we still use the normal distribution. In fact, for valuation, we assume normality. But for risk management, we don't want to assume normality. We tend to assume that there may be fatter tails in the equity return. And this is very important thing I'm saying. If you are doing valuation, normal distribution works perfectly. But for risk management, we look for the empirical distribution itself and use that rather than a normal distribution. Because you cannot just close your eyes on things to say that there may not be extreme values in the tail, when historical data is showing you that there are possibilities of extreme values. Well, this is discussing beyond the scope of this thing we are doing here. So sometimes I don't like to bring in these complexities, so I don't throw people off the lecture, right? That's a discussion we can have another day on advanced topics. Now, so average historical returns should be an unbiased estimate of what investors will expect. So in other words, if the IID normal condition is respected and the markets are relatively efficient, then I can say that if I get the daily return today, the average daily return, that becomes an unbiased estimate of what investors will expect to earn in the future. If this condition is right, we go ahead to conclude that the historical approach can be used to estimate equity risk premium. So all this while, I was just trying to explain to you that the historical returns is a model that we can use. Let me check if there's any question. I'm not sure there's any question. Today, guys, are you enjoying the class? Let me see some few comments. Are you guys enjoying the class, or is it too difficult today? Is it too difficult? Are you learning some new things? Let me see some comments in the chat. Insightful. Oh, I see. Insightful. I am Nelson, and insightful NLT. I see. Great. Wonderful. Let's proceed. think three more comments. It's not too difficult. It's too abstract. Yeah, it's appearing abstract, right? It's appearing abstract because we have not started using the data. And I have some data we use. Yes, we are following the pace is good, enjoying it, but we'll definitely have to rewatch. Yeah, very intriguing. Because it's fantastic. It's a mixture of all I've learned from school. Yes, and this is great. Yeah, so yeah, it may appear abstract because we maybe if you have ever done equity return analysis before, it may not appear abstract to you, but we are going to do it as well. We are going to do it again. So you look at all those equity data and analyze them. Now, so there are some big questions we need to answer. If we are to use the historical approach, the first question is, which equity index should we use? Is it the Ghana Stock Exchange Composite Index or which one? So the whole rule is that we need to select an equity index that accurately represents the typical returns earned by investors in the market. Okay, the typical return earned by investors in the market. So Ghana Stock Exchange, no. And I told you that I'll throw more light on that tomorrow. But we don't use Ghana Stock Exchange. Most used index is the S&P 500. That's the reason why, see, when we discussing the risk-free, we started an argument from US market. Our market here, risk is not properly priced. The data here is statistically is not good for pricing of risk. The data here statistically is not good for pricing of risk. So we don't do that. We don't often take that route. Now, then we ask ourselves the next question, which period of returns? Or in other words, when we are gathering data to calculate the equity risk premium, should we gather a 2-year data, historical data, a 5 years, a 3 months, or what? Well, long-term data series is actually good. If you download long-term, it's good, but it may not reflect the current market condition. That's one thing. It may not reflect a current market condition. But one thing about long-term is that once you do long-term, a lot of regime changes and like, for example, suppose I download 10-year data. If I download 10-year data, that will take me to maybe around 2015, 2016, there and there. If I download 10 years. And what the data I have, which we'll be using, is actually 10 years. And so, of course, it will reflect the COVID moment, right? But of course, it won't cause much drag on my calculations. But if you use the shorter term data to avoid some representative periods, but you may end up avoiding that. But it may actually introduce more noise in the ERP estimation. And we will look at some of those things, some statistical properties of some of these things later. Analysts tend to favor longer time period as they reduce the standard error. So the standard error actually started. Why not Dow Jones? Dow Jones Industrial Average Index. You see, the weighting in the Dow Jones is price weight. You see, if you look at S&P is more of market weighted index, right? It's market cap weighted, right? The weighting of the constituent in the index is based on market capitalization, but Dow Jones is based on price. Okay, it's based on price, so it's a matter of which stock is doing well. But what if there is a stock that is flying high and high, like this technology stock? However, but the number of stock trading is not that much, so the total market capitalization may still be low, lower than one that the price is low, but there are a lot of stocks, so the total market capitalization is high. The price weighted indices have some problems of their own. That's why the use of Dow Jones sometimes is a bit problematic, right? So it's not something that I often used. Number two, the S&P 500 is tracking the top 500 firms in the United States, and it's considered a very well diversified index, right? And the top 500 firms in the United States controlled or they explain significantly the GDP. So the GDP in the United States, even though Dow Jones is also used as a leading indicator, so is S&P also used as a leading indicator in the United States. S&P tend to be more respected that have several of people still like it. And 10-year period is fine. 10-year period is fine. People go beyond 10 years to even look at 20 years and all that. There are some research that if you look at 100 years ago, but 100 years ago, you end up getting into the Great Depression in the 1930 Great Depression in the United States. All those things will bias your figure. It will include the 2008 financial crisis and several other crises in 1974, the dot-com era in the 1990s. All those things will end up bias the data, right? So sometimes, because of the several regime changes, why not just sticking to maybe a 10-year and you pass your this to the go? It would have been better, right? But then at the end of the whole lecture, I'm going to tell you another story and I'll make life easier for you. So analysts tend to favor the long term. Several analysts tend to favor the long term. Okay. So several analysts tend to favor the long term. Now, so when then we talk about which mean measure to use. So we've been talking about mean. You know, when we calculate the daily return, we need to average it. We need to find a way of averaging it. Or even the manner in which we calculate the daily return, whether it should be simple arithmetic, like the simple arithmetic style we did. We take the ending price for today divided by the ending price for yesterday and subtracting 1. That is cool, but you see, and it's really relevant to maybe assignments where you are doing this using CAPM, right? Because CAPM is a single period measure. So if we use models like CAPM, arithmetic mean is fine. Like that calculation I did, I took the price for today divided by price for yesterday minus 1 to give you the return for today. Well, long return actually is the return measure that is mostly used in finance, logarithmic returns. And there are very good reasons why log returns are better. And this one, we take the natural log. And I'll show you those calculations all in Excel tomorrow. I'll show you the calculation tomorrow in Excel, where we use log returns and why log returns but long returns tend to be lower than arithmetic or simple price returns. Why they are lower too is because of the compounding frequencies. When we take a return, maybe a daily return today, the price maybe the price yesterday and the price today, and we just calculate simple return, we tend to not compound anything. There's no compounding there. But when we deal with log returns, there's a continuous compounding there. Think about continuous compounding this way. This is how we can look at it. In a year, let's say we compound once in a year. Compare whatsoever you get at the end of the year to, if you compound it 12 times in a year, that is monthly, 12 times in a year. And then compare that to, if you compound it weekly, that is 52 times in a year. Then compare what you get to, if you compound it daily, okay, you compound something daily, maybe an interest on a loan or something daily, what you get at the value you get at the end of the year. Then compare it. So if by the time you get to daily returns, then do it in terms of hourly. If you do that every hour, you compound it every hour, what will you get at the end of the day? Maybe reduce it to every minute, maybe every second, milliseconds, then continuous. Okay, so there's a limit where the compounding cannot go further. Like you can get a higher value than, or you can keep increasing the periodicity of the compounding, and that limit has a name. Sometimes they call it the Euler value or something, and it's the E, right? Stuff we use for logarithmic content. So we assume continuous compounding in finance. However, the use of the log return with the continuous compounding will actually bias the calculation of the equity risk premium, or make the equity risk premium too low. That's the reason why for computational equity risk premium, a lot of people favor the simple return. And I mentioned earlier that the log returns are lower than the arithmetic return. And this is due to the Jensen inequality, right? And the Jensen's inequality is not anything difficult to look at. what we call the Jensen inequality. Let me just show you what the Jensen inequality is quickly. I think let me open the whiteboard again to show you Jensen inequality. So I hope by now you can see my whiteboard. Okay, so Jensen inequality is easy. It's just like this. So how do we calculate returns? We take the stock price, right? So if I have a stock price P1 and I have another stock, P1 is the price on the one and P2 is the price on the two, then the simple return, you know how we do it, the simple return at the end of the two will be equal to the price at the end of the two, divided by the price at the end of the one, minus one. Now, this is a simple one we do. However, the logarithmic one or the log return, what you do is that you take the natural log and on your, when you, maybe in your Excel, you see it ln, the natural log of, you just do P naught, P2 divided by P1, that, you don't subtract any one again. And this is easy because I want to show you why this is this intuitive. Log ln is the same as to say log to base E is what we call the ln. And don't forget, when you do this you are going to get a return, right? You get R, but this is the log return. Now, so ln is the same as log to base E, and that is actually log to base E, then you have the P2, divided by P1, okay, divided by P1. Now, from the laws of logarithm that we studied in high school, we know that log of, my handwriting is quite terrible, right? Well, laws of logarithm, we know that log to base A, log B to base A is equal to C, can also be written as, let me find a space at the top, right? Can also be written as B is equal to, A to the power C. So if we can write log B to the base A as B is equal to A to the power C, then we can also write log E to, or log of this price relative, right? We call it price relative. P2 divided by P1 is equal to R. You know, I told you it's also equal to a return. We can also rewrite it as E is equal to R, E to the power R is equal to P2, you know, P2 divided by P1. Okay, now, so that is the expression. That's where you get an E to the power R. E to the power R is the price relative, right? So that's the whole idea. So if you want to find P2, is basically just taking P1, you know, taking P1 and multiply it by E to the power R. Okay, so that's a compounding. But the whole Jensen inequality I was trying to demonstrate to you is that because E is the compounding, or maybe we are doing this continuously, the R, or the return you end up getting, okay, would definitely, the return you end up getting, which is the price relative P2 divided by P naught, P2 divided by P naught, the price relative of these will actually be lower or equal to, sometimes I think it will be lower or equal to the price that you get if you use the simpler one. And so you know, so if we use logarithms in calculation of the daily returns, we tend to underrate or underestimate the equity risk premium. But let me tell you this: in all finance, in all pricing of derivatives, is the log returns that I use. The log returns assume a lot of things. It assumes some compounding, and also, in pricing derivative, actually, there's one assumption that this underlying stock price is log normally distributed. Because of that assumption that the underlying stock price is log normally distributed, we also ensure that all the returns we calculate are also follows or calculated using logarithms. Because if you take the log of a log, if you take the log of the stock price, you get a returns, right? And that's what we've just tried now. Okay. I don't know why this is happening to me. I think there's a question here. Let me pick this question. It says, thanks for a long answer. Is log return the same as geometric mean return? No. Log returns are not the same as geometric returns. Log returns are not the same as. Geometric returns are still discrete. They are still discrete. They are a form of discrete compounding, but log returns are not discrete compounding. They are continuous compounding. And a lot of things are priced in the financial world using log returns. In most models in finance, log return is what we use. In most simulation and in Monte Carlo analysis and all that, we all use more log returns for all that. So I said, sorry, I may have missed it, but why is the composite index not appropriate? Well, I said I'll throw a lot of insight on that tomorrow because of the time, and I don't want to get into the data. Tomorrow I'll do a lot of data analysis to conclude this discussion on cost of equity, and there I'll talk a little more about this. But then when we so the simple return should be fine, right? When we move to which risk-free rate to use, we discussed that already. So these are the 4 questions we need to answer when we're doing historical approach or using a historical approach. Because tomorrow we're going to do a lot of the analysis. I don't want to talk about how these things are computed now because of time, so I can discuss all that tomorrow, right? Let me conclude on the forward-looking. Now, the forward-looking approach here to the estimation of equity risk premium, there are 3. We have the survey, we have the Gordon group, and we have one called the macroeconomic modeling, right? The survey, of course, speaking to experts on the market or what they believe the equity risk premium is. The Gordon group, I'll talk a bit about it because if you look at it, what is a return to investors? You see, sometimes when you see formulas, don't just throw in the towel. You have to ask yourself, think about things in practical sense. If you buy a stock, what returns are you getting? Definitely when you buy a stock, you are going to get a return in form of dividend. Dividend, you expect some dividend to come to you. And then what again do you expect? You expect growth in the stock price, isn't it? So when you take the dividend plus the growth in stock price, and this growth in stock price is coming from the fact that the business is growing or earnings are growing. So when you take the growth in stock price plus, the dividends being paid or the dividend yield plus the potential growth in the stock price, the two comes together to give you the expected return on the stock, right? That's what we expect. And I've written this E by E to show expectation, right? The E outside is expectation. So in fact, the expectation, the E actually we use is a curled E. Well designed. If you do a bit of statistics and probability theory, you tend to see a lot of these E expectations. But I mean expectation here, though the E is expectation. So here I'm saying the expected dividend yield. And dividend yield is dividend divided by stock price. So you can see that the price is price not. In other words, the price today. But dividend D1 is the expected dividend. So the expected dividend plus the expected growth in stock price or growth in the company. And then when you add the two, it gives you the return on equity or expected return on equity. Now, or the expected equity return. Then you subtract the risk-free rate and that gives you the equity risk premium. So this is forward-looking. It's about what we expect. That's the Gordon growth. But again, there is a third method, which is the macroeconomic modeling. And I'm going to show that the macroeconomic modeling or model actually simplify the model that we'll be using, which from the macroeconomic side will simplify to Gordon growth in the long term. Let's check it. It's called the Greenwald-Kroner model. And in the Greenwald-Kroner model, what we are doing is that we are decomposing the equity return not only into dividend yield and growth, but we are decomposing equity return into other three elements. Now let's look at it. The return that comes to investor include the dividend yield, and here it reflects the expected dividend yield on the equity investment. So now, all that we are doing today, we are not calculating the return on any particular stock. We are calculating return on the market or how equity market in general will perform. In other words, how will the S&P 500 perform? How will that broad-based market index perform? Not how will so and so company stock perform. No. So when we are saying dividend yield to is a dividend, if we are saying dividend, is a dividend on the index dividend, not a dividend on a single stock. So the dividend, the index dividend is the total dividend of all the stock in the index weighted according to the way the stocks in the index are being weighted. Now, so this information is public in the not quite public in the United States, but then several analysts produce information on this. And then the second one is that as far as the returns that come to shareholders, shareholders buy shares from the company, or in other words, companies issue new shares and buy back some shares. And think about it this way: that when companies issue new shares, they receive money. When they buy back shares, they give out money, and they keep doing that, right? In the long run, what happens? There's this buying and selling, buying and taking money back from people, giving money back to them, taking money back, giving money out to them. And in the long run, we assume that the total shares or share capital, the total value of shares floated, or the total issuance will be the same as the share repurchase. They'll cancel out. And therefore, even in the long run, the net changes in share outstanding will be zero. Now, look at the G. The G is the real growth rate. Because we are talking at the level of the market, and we know that the S&P 500 track the economy really well, we can agree that GDP growth rate will be a proxy for the expected growth in the S&P, or for the expected growth in the earnings of those companies that are part of the S&P 500. So the G is the real growth in the earnings of those companies that are included in the S&P 500. So we can use the G, the growth rate in GDP, to forecast that. Now, so another thing to forecast as a return on the S&P or the broad base is inflation. Inflation is also one. So the R here, the G here is the real growth rate, which is the real GDP growth rate. But then we know that earnings of corporations are nominal. Okay, they include inflation. So we need an inflation measure. So the same approach I used before to show you how we calculate inflation is what I have here. That's the YTM on treasury bond minus the YTM on treasury inflation protected bond. So the first treasury bond is a nominal bond minus that of the inflation protected bond. So you can use this approximation or use this more of so I call it a geometric approach. Okay, so that's how we get the expected inflation that we use in the Greenwald-Kroner model. Now, so far, we have talked about the dividend yield. Then we talked about the change in shares outstanding. We talked about the G and the I as well. Now, when you combine the G and the I, it gives you the growth, the nominal growth in earnings of the companies in the index. Then we have the P, which is the expected repricing, expected changes in the P ratios within the market, right? Now, this also produces a form of return to investors because of how pricing and done and all that value stock and growth stock and a whole lot of P's plays that, right? Some companies are undervalued, companies are overvalued, blah, 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 and all this argument. Now, the whole idea is that in the long run, I'm coming, let me check something. Okay, in the long run, the P's are supposed, the price to earnings ratio are supposed to be stable. They are not supposed to be changing. So think about a situation whereby they are undervaluation and overvaluation. Over time, that corrects out, right? If it corrects, do we still see it happening? In the short run, you may be considering a stock being undervalued. Maybe the price to book or price to earnings ratio is too high or is too low or something than how it's supposed to be in the short run. So you can see those kind of undervaluation and overvaluation. But in the long run, we don't expect that there should be undervaluation or overvaluation, and therefore we don't expect mispricing on the market. If we don't expect mispricing on the market, then the change in PE will be zero. So what are we saying? If we have the change in PE being zero, we have the change in shares being zero in the long run, then what are we left with? We are left with the dividend yield plus the real growth rate plus inflation. If we take the growth rate here plus inflation together, give us a nominal growth. So we are left with the expectation around, I should have written E outside, expectation around the dividend yield plus the growth, the nominal growth in earnings. And that is the same as the Gordon growth model we have here. So Greeno Krona estimated to that. So if you are doing an equity return forecast on the S&P, you can look at what analysts are saying concerning the future or the expected dividend on the S&P. Then you divide that by the index level today, which is the price, plus the expected growth in the US economy, the nominal growth in the US economy. Then you subtract the US risk-free rate, and that gives you the expected risk premium on the S&P in dollar terms. Good. So that is what I've just explained. And the second comment should have been the beta statistics, but it's good I'm ending it here because tomorrow the beta statistics is going to lead me into linear regression, where I'll talk about linear regression, simple linear regression. You estimate the beta from a simple linear regression, using a simple linear regression, and we will go ahead to look at other adjustments that have to be made to the cost of equity. And when we use the linear regression, we are going to use the linear regression, and through the linear regression, we are going to make the argument into cost of equity, into the capping, how the linear regression equation transform into the capital asset pricing model. We will look at that, and we will answer the question of whether capital asset pricing model is actually relevant for any company here in Ghana or in emerging market. Then we'll answer the question that, well, if it isn't relevant, how then do we do about it to adjust or to make it relevant? So we'll answer all those questions tomorrow. And then tomorrow, we'll go ahead and compute the cost of equity for a bank in Ghana. But don't forget, tomorrow we're going to do some stock data analysis. And that's what we are going to use to do the regression. And see you tomorrow. And before that, look, before you go, don't leave yet. There's a question here I want to answer. This one is not visible on YouTube. I'm sorry. Sorry, I've missed it, but why is the okay, I'll look at that later. Don't go yet. Can we say expected growth portion is expected capital gains? Yeah, we can look at that as expected capital gains, right? We can look at that as expected capital gains. Okay, so put something in the chat, as I always do. Today, you've not seen my face, right? Let me see some things in the chat, okay? I've been talking all this while, so let me see something in the chat here from you, so that I know that whatsoever I'm doing, I'm getting some responses. So Nelson said, Julius, thank you so much. I keep learning new things. NLT said, great session. Kuku said, great lecturer. NLT say, need to sharpen my statistics. Yeah, tomorrow is statistics, guys. And this is statistics. And this is statistics, right? And you're going to enjoy it tomorrow. We'll do some regression and see how we can transform that to CAPM, right? I need to sharpen awesome class. So tomorrow we'll do a bit of portfolio theory as well. Awesome class today. The more mathematical the class, the fewer the students. I noticed that. A lot of people realize maybe this is not their calling, right? But then everyone will enjoy it. A whole lot to consume. Yes. Stan, can't wait to learn more. You're going to learn more. Trust me. Hi, Genius, great class today. Again, we'll have to listen before tomorrow. Yeah, please go back to listening to this again, because what I'll be doing tomorrow, I'm going to build it on what we have done now. As I mentioned, we'll talk about this CAPM, right? We'll talk about CAPM, and I may take you a little bit deeper if we have time to show you some things that you'll really be happy about. It's a great one today, and I'm happy to be with you. So we'll end the discussion on discount rate tomorrow, and from there you'll get back to our bank. And now we estimate discount rates. We are now going to look at the cash flows now, and that's where we start some financial modeling for the banks. We'll do financial modeling from Wednesday. We'll start financial modeling. Very useful to prepare me for a role in portfolio analysis. Yes, I was looking, but I've never been exposed in this area. Oh yeah, you're going to really learn a lot tomorrow, especially that you apply a lot in portfolio theory. So tomorrow we'll see. Go and revise concepts like covariance, correlation. Go and revise all those concepts before coming tomorrow. Covariance, correlation, for standard deviation, and all that. Thank you very much. Thank you very much. Ifriye, over to you. Are you there?
Yes, I am here.
Good.
Much for me today. So thank you again, Julius, for your time being with us since last week and today. And for everybody, if you would need a refresher, it's available on YouTube ahead of tomorrow's session. So thank you and enjoy the rest of your evening.